Hello and welcome to Module 4 Part 2. In this video I will be giving you an introduction to private equity. What is private equity? Private equity could be described as fundraising for a private company. Say a company wants to expand or invest in research and development. They start the process of acquiring outside capital investment. Private equity investors become part owners and partners in the business, taking a controlling interest. If the company starts to become profitable, the investors also profit. It differs from holding stocks, as stocks can only be bought in companies that are already publicly traded on stock markets. Private equity is an investment in a privately owned business. So how do private equity funds work? Typically, private equity funds invest in companies that are quite well established. By contrast, venture capital firms give money to startups or younger businesses. One of the most famous venture capital firms in the world is Sequoia Capital, based in Milano Park, part of Silicon Valley in California. Notable investments made by Sequoia Capital include Apple, Cisco, Google, YouTube, Instagram, PayPal, Zoom, and WhatsApp. A private equity fund puts investment capital in companies that make up a portfolio. Most private equity funds are structured as limited partnerships and they are governed by the terms set in a limited partnership agreement. The funds have a general partner that raise capital from high net worth individuals and cash-rich institutional investors. Once invested, equity funds are very difficult to withdraw as the investment is locked up for longer term for a period of maybe 12 years or more. The assets are therefore called illiquid. Profits can only be made as companies that make up the portfolio are sold and converted into cash. But limited partnerships cannot demand that sales are made, making it a passive instrument. So what sort of people invest in private equity? Private equity investors can be individuals with a high net worth, or they can be a firm with large substantial capital. These firms and people have the wherewithal to have their capital tied up for a long amount of time, and they can afford to lose all the money that they invest. Reality TV star Kim Kardashian recently founded her own private equity firm, Sky Partners. Private equity is not just used for the expansion of private companies. It's sometimes used for takeovers of public companies. A classic example of a buyout deal was when Elon Musk bought Twitter for $46.5 billion, turning it from a public company into a private one and rebranding it as X. To raise capital, Musk used $21 billion of his own money and $12.5 billion from private equity from private investors such as the co-founder of Oracle, Larry Ellison, and private equity firms including Sequoia Capital. Musk also bought Twitter with a $13 billion loan from Morgan Stanley, Bank of America and Barclays. Many private equity investments are in a similar way leveraged with debt financing, hence the acronym LBO for leverage buyout. Through these deals, a company acquires debt to eventually expand. However, the debt acquired makes a very risky investment if the company is not profitable. Another type of private equity deal is a carve-out, where investors buy a division of a larger company. During 2021, in a deal valued at $63 billion, computer giant Dell sold its cloud computing business, VMware. Carve-out deals are generally considered riskier, and it's hard to fully separate a business division from its original parent company. Sometimes a private equity firm might buy a company from another private equity firm in what's known as a secondary buyout. The main ambition of a private equity investor is to create more value in their investments. This can mean dramatic change for the acquired company, but creating value does not always mean cuts. Investors focus on expansion, leverage, which is borrowing to expand, and operational improvements. A recent report from EY shows that PE firms have shifted to look at environmental, social and corporate governance issues, or ESG for short, as a key driver of creating value. After acquiring Poland's largest convenience store chain, Żabka, British private equity firm CVC implemented several ESG savings and efficiencies. The chain eventually won Green Portfolio Company of the Year in 2020, and gross margins increased by 3.9% between 2017 and 2020. Private equity is associated with the potential of high returns over a longer-term time horizon. The US Private Equity Index provided by Cambridge Associates shows that over a 20-year period ending on the 30th of June 2020, private equity produced an average annual return of 10.48% compared to the S&P 500, which generated a return of 5.91% during the same period. It's important to note, however, that returns in high-risk investments are never guaranteed and investors can lose all of their invested capital. Private ownership does mean fewer stakeholders, making for more efficient management. It can streamline the decision-making process and keep the focus on margins and cash flows. PE managers are always seeking a buy-to-sell strategy. They look for opportunities to increase the business's value and sell at a higher price. A private equity co-investment strategy is where a private equity manager makes a minority investment in privately held companies, investing their capital alongside other private equity managers. A co-investment manager builds a portfolio of these direct company investments across different sectors and opportunities. Co-investment funds benefit from having no management fees or performance fees attached to a sale, and they typically charge lower fees on their funds than managers of active equity. There is always a high risk associated with private equity investments. If a company falls for whatever reason, the investor can lose all of their capital. The risk to capital is even greater in venture capital funds, as these portfolio of companies are at the earliest stages of development. A recent example of this was with the health tech company Theranos, that claimed to be able to perform hundreds of blood tests with just a single pinprick of blood. The company raised more than 700 million from venture capitalists and private equity investors. In 2013, it had a valuation of 10 billion, but by 2018, all the company claims were proven to be false. This resulted in investors losing all their money, and the company founders Elizabeth Holmes and Sunny Bhawani being found guilty of fraud and sent to prison for over 10 years. Theranos might be the best example of why even when a company appears to have an exciting, possibly world-changing technology, investors should never put in more capital than they can afford to lose. If private equity sounds of interest to you, seek professional advice and keep in mind the illiquidity and high-risk nature of this long-term investment. In the next video, my colleague Katrina Cody will be telling you all about share options and the tax framework around them. Thanks for watching and good luck with the rest of the module.